Welcome back to ACCA Masters. In this video we will talk about inventories, and we have an accounting standard which deals with inventories, and its name is IAS2 or International Accounting Standard number 2. So basically this standard tells us how to create inventories into our accounting books. So we treat inventories in our profit and loss account as well as into our balance sheet or statement of financial position. Let's talk about the pro forma of profit and loss account. So first of all we have sales, from which we have to less cost of sales. The cost of sales is basically the direct cost of producing the goods which is sold by the company, in which first of all we have opening inventories, then we have purchases for the year of, let's say, current year. Okay, we add this amount into our opening inventories, and finally we have closing inventories, which we less from the total of both of them. So if we net off them, then we will get our cost of sales for this year, right? And we will less this amount from our sales. As a result, we will get gross profit for the year. And we take this closing inventories into our balance sheet, and it becomes our current asset for the year. The higher closing inventories will result in higher profits for the year. So basically these inventories are usually held by manufacturing companies. There can be three processes. For example, first of all, the company has purchased raw material, and then the company use some of these raw material and start processing them into finished goods, which is known as work in process, right? And finally we have finished goods. These are the goods which the company can sell directly into market. And in order to value these inventories, the company can use either of the following three methods. The first one is known as FIFO. Secondly, we have LIFO, and finally we have weighted average cost method. Okay, so here on your screen we have an example, and we are solving this example using all of these three methods. For example, FIFO, LIFO, and weighted average cost method. So first of all, here we have four different columns. In the first column we have different dates, then we are either purchasing or issuing our inventory. Next we have number of units, and finally we have cost per unit. Okay, so on 1st of Jan we are purchasing 100 units and its cost is $2 per unit, and if we multiply them then our total cost will be $200. And similarly we calculated 175 for 2nd Jan, and now on 3rd January we are issuing 50 units. Because we are using FIFO method, so we will take this cost to issue our units, because remember it's first in and first out. So these units were first in, that's why we are outing them first, right? So that's why we are using $2 here. And if we calculate them then it will be $100, and on 4th of Jan we are purchasing 100 units for $5 each. And we can get the value of our closing inventory by netting off all of these amounts, which is $775 in this case. Now let's solve the same example using LIFO method. First of all, we have total cost of $200, okay, of our inventory, and we have calculated it in the same way as we calculated these $200, right? Then we have $175 for 2nd Jan, and we have $500 for 4th of Jan. But the treatment of 3rd Jan is different. So as its name is indicating, last in and first out. So on the last we are purchasing these 50 units and its cost is $3.5 per unit. That's why we are using this cost in LIFO method. And if we multiply both of them then we will get $175. And again we can get the value of our closing inventory by netting off all of these amounts. So our closing inventory according to the LIFO method is $700. Now let's solve the same example using weighted average cost method. Please remember this concept. The concept is very simple and straightforward. At the end of each transaction, we have to apply this formula in order to calculate our cost per unit. Okay. So on 1st of Jan, we have bought 100 units and its cost was $2 each, and that's how we calculated $200. Now if we divide total cost by total units then we will get 2, and don't need to do it on 1st of Jan because it's our first transaction. On 2nd Jan we have purchased another 50 units. Now this time its cost is a bit different. So if we sum up both of them then we will get our total cost, and if we add up both of them then we will get our total number of units, right? So by dividing total cost by total number of units we will get our per unit cost. Okay, and on 3rd of Jan when we are issuing 50 units then we will use the recent cost per unit, which is $2.5, right? And again we will sum up all of these amounts and all of these units and we will put them into our formula, and again after the calculation we will get $2.5. On 4th of Jan we will use total cost and we will divide it by total number of units, and that's how we will get $3.75. And finally if we net off all of these amounts then we will get the amount of our closing inventory. Now here you can see if we were using FIFO method our closing inventory was higher. According to LIFO method our closing inventory was lowest, but if we talk about weighted average cost then here our inventory cost was in the middle of both of them. I hope you understand this concept. Now let's solve some exam kit questions. And if there we have any similar example like this one we have just solved, then you will be required to solve them because the method to solve them will be similar. But in the case of any question, you may ask me. Okay. But before solving the questions, we have one more point here. So we have just studied three methods by which we can compute the cost of inventories. Okay. Now according to IAS 2, there is one more point. The inventories must always be recorded at lower of its cost or NRV. And by NRV we mean expected selling price of inventory minus cost of selling those inventories. So here we have our question number 1. In times of rising prices, FIFO method of inventory valuation when compared to average cost method of inventory valuation will usually result in which of the following? And it is an important question from the exam point of view because the examiner frequently tests this question or similar question like this. Okay, and its answer will be B. Now please let me tell you the logic. According to FIFO method, we use that inventory which come into our stock first, because FIFO stands for first in and first out. So let's say in June our inventory was costing us, let's say, $100 for 10 units, and in July the same 10 units now costing us $120. And let's say it's August and now the same 10 units now costing us $130. Now if we use FIFO method, then we will use these 10 units first because we want to out that inventory first which we bought earlier, right? Now that means, let's say our sales were $500. If we use inventory of this date, then as a result we will get profit of $400. But let's say if we are using inventory of this date, then that means we are required to less more amount from our sales and our ultimate profit will be decreased by $30, right? So that means in the time of rising prices, FIFO method give us higher profits and higher closing inventory because we are selling inventory of low price. That means the inventory with higher price will remain in our stock. That's why our closing inventory value will be higher. Now next we have question number 2. How are his net profits for the year and net assets at the end of year affected by this error? D made an error when calculated the value of his closing inventory, which means that the inventory is overvalued. So that means if our closing inventory is overvalued, then our net profits will be increased. And if our profit is increasing, then in that case our net assets will also be increased, right? Because our net assets is our capital, and we know in capital we have opening capital plus profit for the year plus new capital and minus drawings. So if profits will increase, then the net assets will also be increased. Now next we have question number 3. In this question we have been asked to calculate the value of inventory using weighted average cost method. And the method to solve this question is exactly similar to the example we solved earlier. So I required you to solve this example by yourself, and in the case of any question you may ask me. Next we have question number 4. During May 07, as purchases were this amount, her sales were this amount, as gross profit was 20% of sales, the value of her opening inventory was this amount, and we are required to calculate the value of her closing inventory. So we will use the same pro forma. First of all, we have sales, from which we less cost of sales, in which we have first of all opening inventory, and we add purchases into this amount, and we less closing inventory, and finally we get gross profit. So the question is saying that our gross profit is 20%. So let's say here is our sales, and here is our cost of sales, and here we have our gross profit or GP. If our sales are 100% and our gross profit is 20%, then that means our cost of sales will be 80%, right? So let's take the 80% of 150 to find out cost of sales. So the 80% of 150 will become 120,000, and in order to find out closing inventory we will simply rearrange this equation. Okay, so let's say here we want to calculate closing inventory, which will be equal to opening inventories plus purchases for the year, from which we will less cost of sales, and we have already find out the amount of cost of sales, right? So here we have 120. Our purchases for the year are this amount, 126,500, and our opening inventory is 125,000. And if we net off them, then we will get answer of 19,000, which is our closing inventory amount. Now next we have question number 5. What adjustment should be made to closing inventory? Paul discovered that goods with a cost of this amount and net realizable value, which stands for NRV, of $3,000 have been omitted from the year-end inventory count. So that means according to IAS 2 we have to take lower of cost versus NRV, and the lower of amount is 3,000, right? That means we will increase our inventory with the amount of 3,000. Further we have question number 6. Which method of inventory valuation is used when issues are assumed to be taken from the inventory in the order in which they were received? So basically here they are talking about FIFO method. For example, the first inventory we have received or purchased will be out first. Now next we have question number 7. What was the correct value of closing inventory at 30th June 02? This inventory was valued at its cost of 45400. This included item costing 2600, which have since been superseded by an updated design. D will be able to sell these items through an agent for this amount. The agent's commission will be 10% of selling price. So again we are talking about IAS 2, which requires us to record inventory at lower of cost versus NRV, or net realizable value. So here in this case our cost is 45400, and an item of this amount is expected to be sold at this amount, right? So that means now we have to calculate the NRV of this item, right? So we can calculate it using this formula. First of all, we will less the amount of its original cost, then we will add up the expected selling price, which is NRV, into our total cost, which is 1400, and because there is an associated selling cost, so we will also deduct this amount from our total cost, and that will be 140. So now if we sum up all of them, then our closing inventory will be 44060. Now next we have question number 8. The method to solve this question is similar to question number 7, so you are required to do it by yourself. Now next we have question number 9. It is very straightforward question. Which of the following is the correct formula to calculate cost of goods sold? So it is opening inventory plus purchases minus closing inventory, which is D. Now next we have question number 10. Which of the following statement is correct? T has recently commenced trading. The materials he uses in his business are subject to regular price rises. He is unsure how to value his inventory and is trying to decide whether to use FIFO or continuous weighted average cost model. T's profit will be unaffected by the method of inventory valuation, and it's untrue, we have already discussed about it. FIFO will lead to a higher reported profit, and yes, it's true, and we have discussed it in our question number 1 also. Now next we have question number 11. A sold some items of inventory which she had bought for 2622 for 1950 in cash. So basically she is selling these inventories at less amount. In other words, we can say that she is making loss, and the difference between both of them is of $672. So her profits will be reduced by this amount, her assets will be reduced by this amount, and also her capital will be reduced by this amount. So the correct option is option A. Now next we have question number 12. Under the continuous weighted average cost model, which is also known as FIFO method, what is the value of inventory? And you can solve this example using the same approach as we did our earlier question. And finally we have question number 13. Again, in this question we are required to calculate FIFO, and as you know the approach how to solve these questions, so you are required to solve this question by yourself, and in case of any question you may ask me. Thank you very much, and that's all for this video.